Hello, everyone, and thank you for joining us for 5 reasons why QuickBooks could be hurting your firm as part of the LTRC Industry Insight Series. Our speaker today is Erica Bursler. Erica is the Vice President at CosmoLex, developers of the only fully integrated legal practice management, billing, and trust accounting system specifically designed for solo and small law firms. Erica's degree is in business administration, and she has nearly a decade of experience in the legal software industry, catering to the specialized technology needs of small to mid-sized law firms. Erica is passionate about helping legal professionals improve the way their law firms run, and she has given numerous presentations across North America on legal technologies such as law practice technology management, cloud computing, and legal billing and trust accounting compliance. Thank you all for joining us. We'll now begin the webinar.
Welcome everyone, and thank you so much for attending our session today. So the topic of our session is specifically 5 reasons why QuickBooks could be hurting your firm. So what we'll do throughout the session today is we'll talk a little bit about what legal accounting is. We'll go through those 5 reasons, and then of course, keeping that in mind, what are the important things to look for when choosing an accounting tool. We do have a handout, which is located in the GoToWebinar panel right now. That's actually a white paper on common challenges of QuickBooks Online, so you're welcome to download that at any point during the presentation. Okay, so in terms of legal accounting, I always like to start with the basics, the foundation, and this actually factors a lot into the challenges of generic accounting tools, all different types of generic accounting tools. So when we're talking about legal accounting, there's 3 main components. You have the general business accounting portion, which is what most people think of when you think of accounting. It's tracking your income, your expenses, generating your profit and loss, maybe putting together your documentation for taxes, general daily business accounting. And that's pretty similar across most industries. But the next 2 areas are very much legal specific. So there are functionality within matter costs, meaning those client costs that you pay out of pocket that need to be reimbursed. Those are quite common. But also when you receive payments on your invoices, that income, it's not just 100% fee. You know, you have fee, you have indirect costs, direct costs, you have maybe finance charges, maybe fee being distributed amongst different people. There's a lot of combinations that could take place that increases the complexity over any other business. And then the last section is fee advances and retainers accounting. So that's where we get usually into managing trust funds and the compliance around that. And all of the challenges that we talk about today center around this concept of legal accounting and how the day-to-day accounting tasks can differ for a law firm, or the requirements, I should say, can differ for a particular law firm. And tools like QuickBooks, and when I use QuickBooks, I'm just referring to generic accounting tools overall. There are other tools out there, but they're definitely the industry leader, but they're purposely industry agnostic. They're trying to appeal to a larger audience. So they're not looking to be legal specific, medical specific, real estate specific. They're not looking to do that. They're looking to be fairly generalized. So for the general accounting functions, mainly that first point that I mentioned here, it is the de facto standard. It has a lot of robust functionality that can be helpful for your overall managing of your business and financials. But for the unique legal accounting functions, that's where a majority of the challenges that we'll talk about do exist. And I think it's important to, as we go through the challenges today, just think of you may currently be using tools like QuickBooks, you may be considering it, but how is your firm functioning with these legal specific functions? Are there some workarounds? Are there some complications? Are there gaps? Are there challenges? And hopefully this session will help you to just kind of look a little bit deeper into those. So our first challenge, and definitely the biggest, is trust accounting compliance. And the reason why this is so large is because no other business needs to deal with trust accounting. It's very specific to the legal industry, especially the requirements. They could vary by the state that you're in. They can definitely vary by even the practice area as to how that money should be handled. And it's the firm's responsibility to make sure they have a good understanding of what those requirements are, and that whatever tools or processes that you have in place fulfill those requirements. It usually comes down to an audit. You know, if you were to get audited, are you able to have proof or reporting or documentation that you're handling that trust account the way that you should? Now, the reason why this is one of the biggest challenges, I say, not just because of the legal specific nature, but because this is not your money, it's your client's money. So the strictness of the compliance is very different than if you're just managing your business account or any other bank account that you have. So you have kind of a duty to uphold to your client to make sure you're managing these files correctly. Now, in terms of concerns, so I mentioned that, you know, generic tools are not legal specific. So what type of functionality are we talking about? What could be some of those challenges? The first is maintaining matter-centric ledgers. So for trust accounting in general, of course, it all comes down to having a ledger per matter, ledger being all of the trust activity in and out per specific client file or matter. Now, many accounting tools, they have a concept of a project or a job or a customer, but there's no restrictions around it. You can kind of set it up however you would like. You don't have to use that structure. It's not forcing you to. More importantly is what can happen within that ledger. So let's say, okay, I've set up my customers, or however you want to refer to it, depending on the tool, based on the particular client file or matter, and I'm going to receive money in and out. Well, one of the biggest compliance requirements is to not overdraft on a ledger and not commingle funds. So what we're referring by that, overdraft is, of course, you think of a bank overdraft. If I have $20,000 in my bank account, I can't take more than that. But I might only have $1,000 for John Smith. Well, I can't, even though I have plenty of money in the bank, I can't take more than that $1,000 for John Smith. Any tool that is not legal specific is not going to stop you from doing that. You can cut a check for whatever amount that you want. You can overdraft on the bank level if you want to, because they're purposely overly flexible, which is why a lot of accountants like them, because they're so flexible, but that flexibility can also cause you to do wrong actions like overdrafting. Commingling can be in a few different ways. One is if you lose track of your matter ledgers, which is very easy to do, you can end up kind of confusing whose is what. That's one form of commingling. And when you're talking about tools like QuickBooks, what tends to happen is if whatever software you're using, and this also accounts for if you have written ledgers or if you are using Excel or something like that, if it's not forced that every trust transaction you do has to be linked to a matter, commingling, the risk of that is very high. Because if I can receive money into my trust account and not assign it to anybody, or take money out of my trust account and not assign it to anybody, then I will end up with this pool of money that I don't know who it's for, and that causes a lot of issues, not only with reporting, but also you will likely overdraft because you don't know exactly what that particular client has. So avoiding that can be quite difficult in a generic tool. Monthly reconciliation. So typically from an accounting perspective, like most businesses, they just have an ongoing reconciliation. You know, I can reconcile a quarter, a year, a couple months, with the trust accounts required to do that monthly for law firms especially. And you want to have a very tight control over that. And again, most generic tools are very flexible. So what I mean by tight control is, okay, if I'm looking at this month, I want to close this month, I should not be able to easily change what happened in that past month. If I've reconciled and I've signed off on it, I shouldn't be able to go back and just change whatever I want, because what that does is it throws all of the rest of the reconciliation off, and that then needs to be fixed. But again, the flexibility of these general tools will not prevent those types of edits. And then the compliance reporting. This is probably the biggest area where it's like a requirement. If you were to get audited tomorrow, they're going to say, okay, we need X amount of trust reports produced. And if you're not sure, whatever method you're using, whatever tool, software, Excel, whatever it may be, if you're not sure right now if you can produce those reports, you're going to end up in a tough situation, because that is majority of what an auditor at least starts with, and then they may dig deeper based on that. And I've actually added a list of reports here, and I'll kind of explain what each one of these are from a top level. And even if you yourself don't handle the accounting for your firm, have a conversation with your bookkeeper or your accounting staff to say, hey, These types of reports we should be able to produce each and every month. Can we? Because that's how we know whether or not we are compliant or not. So kind of going down the list, a bank journal. That is basically your bank activity. So if I do a bank journal for my TD Bank trust account, it's going to show me everything that was on my books, meaning everything I've entered in my accounting tool for that particular bank account, money in and money out. Receipts and disbursements. Receipts is deposits only, disbursements is withdrawals only. They like to see this separation because if they're looking for discrepancies pretty much. Every one of these reports, for the most part, has a running balance. That's another important thing to note. The reason why these reports have a running balance, or they should, I'll say, they should have a running balance because the auditor is looking for those negative overdrafts. They come out with a running balance, and they'll request that very often. Trust ledger balance is each matter and their respective money in trust. So if you have 100 matters, you should be able to have a list of 100 matters and know exactly what they have in the trust account. Client trust ledger is, I'm looking at John Smith's file. What happened in the trust account for John Smith? Money in and money out just for him, just for that particular client. And how did I end up at the balance they now have? And then the last two is related to reconciliation. So as I mentioned with the trust account, you have to be able to reconcile regularly. Monthly is typically the requirement. And there is basically with reconciliation, you're comparing your bank and your book and you're saying what has cleared, what hasn't, are they matching? Are there any discrepancies? Are there any issues? It's not a trust specific function. Reconciliation is an accounting function. So any accounting tool has reconciliation functionality, but it's the reporting that comes from that. And one specific report is called the three-way reconciliation. That is specifically for the trust account. And what that does is it will take your bank balance and your book balance, but also all the individual client ledgers from a particular trust account and add that up as well. And I'll pull that up real quick for those of you who are not familiar. I know many people who use tools like QuickBooks don't even know what a three-way reconciliation is because maybe you've never been audited and maybe you've never been asked for it. So let me actually pull up a sample of that. I'm just going to jump into CosmoLex quickly and we'll generate a three-way report so you can see what that looks like. Okay, so I'm just going to select a certain account that should have a reconciled month. So I've already reconciled. I've already done the comparison. That's a piece that you have to do in order to find discrepancies. But then I can pull up this report and you can see I have my reconciled month and it has my book balance, 14,120, my bank balance, 14,120, and then all of my ledgers, which also add up to 14,120. So can you get this information from a tool like QuickBooks? You can. Are they going to match? Quite possibly not. So because there's no built-in three-way check in the system, you can end up with a discrepancy and then have to figure out, okay, how am I going to go about fixing that? But no matter what system you're using, you do want to make sure that you can produce this type of data if an audit were to arise. So this list here, make a note of it and see if you're able to produce these at the moment. Our second item is separation from the legal billing record. So what's interesting is from a legal specific standpoint, I think most law firms understand the importance of legal billing tools because there's so many unique requirements, you know, hourly, fixed fee, different rate structures, different invoice requirements. So majority of law firms do use some sort of legal specific billing tool. But then that leaves the accounting off to something like QuickBooks, and that's very often the solution. They go to a generic accounting tool and they kind of use the two systems separately. It's a very common setup. So when that happens, there are some challenges along with that as well. There are a few main areas where billing and accounting interact in your firm, and you want to be sure that the workflow that you have, the data that's being exchanged is accurate as possible. So the first is capturing and billing for client costs. To kind of spell that out is when you are paying, this is that paying the expense out of pocket scenario. So if you're paying expense out of pocket, let's say you're going to the courthouse, you're paying for a filing fee, I'll say it's $100, that's an accounting activity. I'm going into my, let's say my operating account, I'm entering a check for $100 and that affects my bank balance. Great. But the reimbursement of that is a billing activity. If you have the two separate, the likelihood of that item getting recorded in the billing tool is actually not very good. Most of the law firms I talk to say that those costs get dropped quite often. If that cost is not billed to the client, you will not get reimbursed, and that affects your bottom line directly. So something to think of. Again, figure out what's your workflow right now. How, when you have these costs you need to get reimbursed, are there any gaps? Then it comes down to, okay, I billed my client. So now we're thinking from a billing perspective. I billed my client, I have an invoice, they pay me. All right, well, that invoice gets paid. So I update the invoice balance, I update their AR balance. Everything's good from a billing perspective. But you also need to take that same amount, record it in your accounting tool. And in the accounting tool, you need to say, okay, which portion of this invoice is fee? What portion of this invoice is cost? What portion is maybe allocated to a discount? All of those different entries have to be made from an accounting side. And again, if they're not made at the same time, you can risk some gaps in that as well. And the third is trust ledgers. Believe it or not, which kind of ties back to the prior point, trust accounting involves both billing and accounting. Because you have, from a billing perspective, it's because of retainers. Very often you have retainers and trust. Those will eventually be earned and applied to an invoice. So you have to have your trust balances in whatever billing tool you use because likely they will be used. But you also have to have it in your accounting tool because that's where you're keeping track of different transactions, maybe printing checks, maybe doing your compliance reporting, your reconciliation, all of that takes place in the accounting tool. Now, what tends to happen is you have trust in two locations and the numbers are not matching. You can have all of your ledgers in your billing tool and all of your ledgers in your accounting tool, but because there's so much double entry and so much back and forth, very often they're not matching. And that can cause big issues, either on the accounting side from your reporting perspective, or on the billing side in terms of what's available to be earned as retainer. So you want to make sure that those numbers are always matching, and that does require an extra set of checks and balances on your end. Our third item, this is a little bit specific. We're talking about fee distributions. So what fee distributions are is if you have multiple matter parties. So really, all it means is if you have more than one person who's working on a file, who may, if your firm has a setup like this, who may get a portion of the fee that comes in. Very common when there's multiple attorneys at a particular firm. You may give a percentage to an originator, a responsible, maybe even timekeepers, so that they get rewarded for what they're collecting or bringing in. Kind of the eat what you kill model. This, again, very popular, very common with law firms, not so much with other businesses. It's somewhat of almost like a commission structure. So when we talk about tracking fee, there's a few steps to keep in mind, and then I'll explain kind of where the challenges arise. So the first thing that's important is you need to identify matter parties. You need to have some mechanism and some way of saying, okay, John Smith is the originator on this file, but he's not the originator on that file. Usually that's a custom field or some sort of way of tracking that on that record. You also want to know who the timekeepers are, who the responsible person is, because again, you might have distributions a little bit differently. Then, if applicable, you want to assign distribution percentages. So some firms just want to know, John Smith as an originator, how much fee has he brought into my firm? And I just want that for information purposes. Maybe I want to nurture that relationship more because he's sending a lot of good business my way, just for information. But sometimes it is for that commission type of distribution model, like I mentioned. You know, maybe there's a kickback for originating certain files, especially if you have an outside originator that's bringing business into your firm. You may want to know how many dollars, but I also want to give him 5%. You know, I want to reward this person based on how much money comes in. So it's percentage based as opposed to dollar based. If you are doing percentages, you need to be able to say, okay, John Smith on this file's originator gets 5% of all the fee income that comes on this matter. The responsible maybe gets 10%. A timekeeper might get 20% of the work that they do. And let me tell you, these can get really complicated depending on what your setup is in your firm. The third step is separating the fee from the total payment. So if you have a $1,000 invoice that comes in, that doesn't mean that originator gets 5% of that full $1,000. because that's not all fee. Very often when you're trying to see what somebody brings in, it's specifically fee earned and not costs that are reimbursed. So you need to be able to separate that portion out, know what part of every invoice payment is specifically fee earned, and take the rest of it out of the equation. And last is the allocation reporting. So, okay, let's say I've got my matter parties, I have the percentage, I know what the fee is. I need a report usually every payroll cycle or sometimes every month to say, what did John Smith as an originator, what did he bring in, and what is he entitled to? And usually what happens with most bookkeepers I talk to is they have a way in any accounting tool to using the general ledger to see who brought in what, but the additional piece has to be done in Excel or manually. Also, it can be quite challenging, depending on how large your practice is, tracking those individual matter parties, because that's kind of a CRM type of function as well. And all of these include billing and accounting activity. You know, the fee that gets billed, what actually gets paid, who gets the percentage of what, who actually is on a matter, who's the responsible. If it's timekeeper based, who's actually entering that particular time or responsible for that particular time entry, who has the most time entered on a file. That's all billing related. So it's a combination of both, and very often if they're separated out or if some way disconnected, it can be very difficult to get to that final reporting. Our fourth item is high risk of incorrect postings. So this comes down to, again, the legal specific side of things. If you're using a tool that's highly flexible, it allows you to kind of choose from whatever you want. So that, of course, increases the risk of using the wrong accounts. And when we're talking about accounts, usually it is the chart of accounts, the general ledger, the income accounts, expense accounts, et cetera, that you're able to use. So I notice with law firms, very often when they're using a generic tool, their main areas where they struggle in terms of postings. The first one is the matter linking. So as I mentioned, if you do any type of transaction, whether it's billing, whether it's a like from time perspective, an invoice payment, a retainer you're receiving, maybe a check that you're cutting out to a third party, all of them should be linked to their respective matters. If they're not, it's very, very hard to get accurate financials for your particular client and get the right reporting. So that's one thing. If it's completely missed and not linked to a matter, then your records will be kind of half or not even, incomplete, I should say. Utilizing incorrect GL accounts. So this is the general ledger accounts that I mentioned before. A common example of that, if you're receiving, I'll use trust as an example. If you're receiving a trust deposit, that should affect your liability account because it is not your money, it's not income. It is a liability that you're holding on behalf of your client. Now, in generic tools, you can select any chart of account that you want. Chart of account and GL are kind of the same thing. You can select any account that you want. So if you wanted to allocate your trust retainer to an expense account, you can. That's completely incorrect from an accounting perspective, but you're allowed to do that. Many firms that record trust funds as income when it's not. Should not be recorded income until it's earned. So imagine how that affects your tax reporting because you're inflating your income because that money's not yet earned. So it all kind of ties into each other. Another common example is with client costs. The way that you allocate a client cost is different than a firm cost. A firm cost, I might have, you know, FedEx, and I'm going to record it to a courier account or a postage account. Great. But from a client cost, if I'm getting reimbursed from that, it should be recorded as a reimbursable client cost, like something that is client specific on the general ledger. Different cost types. So I gave the example of a direct cost, which is I'm paying something out of pocket and I need to get reimbursed. There are also indirect costs. That is, maybe I'm passing through photocopies or printing. It gets a lot more difficult when there's no concept of a matter, because a lot of this has to do with how direct or indirect the connection is between a transaction and a particular matter and how that affects your accounting. The the invoice payments or revenue receipts, we talked a little bit about before as well. So when a when an invoice gets paid in a generic tool, this is kind of what happens. If I have that, I'll use the same example of a $1,000 invoice. Let's say I have a $1,000 invoice. It has some fee on it. It has some cost, even has some finance charge. Simple example. I get half payment. I get $500 on that. So that $500, you need to think, well, which portion goes towards fee, which portion goes towards cost, and what goes towards my finance charge? How do I know what should go where? Now, generic tools will automatically apply a partial payment proportionally, meaning that $500 will get sprinkled across all the different items on that invoice. That's actually not the proper way per legal accounting. You should be allocating towards all of your liabilities, like if there's any tax involved, and costs first, and then fees last. So the way that gets applied is not per legal accounting, it's per general accounting. So you need to make sure that the allocations are adjusted accordingly or set up in a way that partial payments are allocated the right way. And our fifth item is missing the firm financial big picture. So whenever you're running a business, any law firm, you are running a business. And I think very often what happens is you have the passion for law, you have the passion for working with your clients. Not all of you might have wanted to be business owners. It might have been something that you kind of stumbled upon, might have been a different path you didn't think you'd take, or it might be something that you absolutely love. No matter what the case, it's important to make your business successful. You want to be there in the long term, whether it's just you or other part of that is knowing the big picture of your financials. How is the firm doing? How can it improve? Or I should say, how's the firm doing? Where do you want to be and how do you get there? And you can't make those goals or those benchmarks without the proper information. Now, if everything's kind of segregated out or not capturing the right information, it's very hard to do so. So here's a list of a few what I call law firm data to keep in mind. Now, some of these are very much legal specific. So again, it's a matter of figuring out how do I capture this information to help me make the right decisions for my business. So the first item here is visibility of AR, which is your accounts receivable. That's what's owed to you. Your WIPs, which is your work in progress. That is what you've yet to bill. And your trust. That view per matter will help you plan out, okay, I have $1,000 in WIPs and I only have $500 in trust. That's going to be a collections issue because I can't even cover my WIPs at this point. Or the AR is getting out of control. This client has owed me money for 6 months. Should I continue to do work with them? Should I maybe bill them differently? Should this be a conversation? The next point is your revenue. Obviously, revenue or profit. Revenue is everything that comes in. Profit takes into consideration your costs by not just the firm, but matter owner, timekeeper, and also practice area, which I didn't mention here. Even if you're a solo, it's very important if you're a general practice to know where that money is coming in from. Is it for your family law practice, your real estate practice? And there are ways of going about this, but you need to make sure that you can collect this information. How are you able to say this item is for real estate, this item is for family law, so that you can properly report on it? Utilization and realization. So utilization is how much of my time spent is actually billed to my client. Are those items falling through, or am I doing too much no charge? Realization is how much of my time spent is actually collected. So you might have a huge collection issue on your hand if you're not realizing fee for all those activities. And then some cost analysis, like my administrative costs. You might be putting way too much money into your unbillable time or for your administrative tasks that could be cut down. Or your client costs, all those expenses that you're paying out of pocket. Are you actually getting reimbursed for those? Are they actually getting billed? Or are you paying so much money on behalf of your client and never getting paid back for it? You don't know what's happening until you collect this information, you analyze it a little bit, and then you say, okay, I want to make changes so that I can better overall, it's usually your firm's income. So some of this information, like I said, is very legal specific, and you need to figure out how you're going to capture that. It is a little bit more complicated than a generic tool. So the last point is, okay, what do I look for? There are legal specific tools out there, by the way, but what's most important? I'm looking for an accounting tool, or I'm reevaluating what I'm going to do with my accounting, or I want to have a conversation with my bookkeeper. What's the most important things for me to look for? First thing is have a complete view of all your billing and accounting activity. They're so incredibly closely related. Actually, billing, when I say accounting, I mean both your business accounting and your trust accounting. All of those items are very, very closely linked with every activity you do from a firm financial perspective. So you want to make sure that's as centralized as possible. Have legal accounting safeguards in place to avoid common mistakes. That could be not allowing trust overdrafts. That could be having the ability, no ability to commingle. That could be if I do a client cost, it goes to the right chart of account. Legal specific tools will have those defaults for you or safeguards. And of course, all the required reporting, both from a compliance perspective, meaning if you were to get audited on a trust account, what do you need? But also from a business analytics perspective. You want to be smart about your business and the decisions that you make, and you want to make sure you're able to produce the reporting to know what direction to take it in the long term.
Great. All right, that's all the time that we have for today. I'd like to thank our sponsor, CosmoLex, and all of you for attending our webinar today as part of the LTRC Industry Insights series. I'd also like to thank Erica for presenting today. We will now conclude the webinar.
Thanks, everyone.